We are joined by the Group CFO of Raymond, Mr. Bahl. Thank you so much, sir, for taking out the time and speaking to BloombergQuint. First, I would like you to ask on the fourth quarter earnings highlight and how exactly did FY18 shape up for you in terms of margins and profitability?
It's been a very good year for us. Strong recovery really from the impact of demonetisation last year and GST as well. Really a testimony to the fact that our strategic drivers that we set out for ourselves as part of our Raymond Reimagined journey have really been executed well. We've achieved revenue growth of around 13% without considering the GST accounting impact. At an overall level, EBITDA margins have gone up by 140 basis points. Now they are at a consolidated level, they are at 9.1%. Our ROC has gone up to around 9% levels, a 200 basis points improvement over last year. A good year in terms of revenue and profitable growth. Also, the working capital management was very efficient. We got efficiencies of 14% by way of reduction in the number of days of net working capital at an overall level. So overall, a very satisfying year for us. In line, the metrics and the performance is in line with the guidance that we had given for Vision 2020, and we are well on course for that.
Okay. Sir, talking specifically about your key business segments and starting with textiles and branded apparel fourth quarter performance, how really was it? And if you could also specifically tell us how do you see the margin improving moving forward since FY19 would be better in terms of sales volume and overall growth on the back of new launches and products?
Our core businesses are branded textile and branded apparel have outperformed our targets for 17-18. Our branded textile grew by 13% in quarter 4. And this comprises a mix of suiting and shirting business and improvement in gross margins also in branded textiles. Really underpinned by a very strong growth in the wholesale channel, which is back up to double-digit growth in 17-18. Institutional sales emerged as a strong category for us as well in the fabric business. And the product innovations that we have done by launch of the Techno series range of products has performed exceedingly well. So branded textile back on the growth path and on restoration of profitability and improvement in margin. In the branded apparel segment, it's good to report that the business has not just grown by 19% year on year, but the segment has also turned EBITDA positive in 17-18. And this is aligned to our vision of really driving profitability in this business along with revenue growth. Over the next 2 to 3 years, we see this business scaling up to double-digit EBITDA. So we are on course with that. 2 new exciting launches that have happened in 17-18 in branded apparel is Raymond Ethnics launch. The pilot was very successful and we see this business scaling up in the next 3 to 4 years to a level of around 500 crores potential in revenue. Also offering our wardrobe solution offering in the value segment through a brand Next Look was launched in 17-18, and this also is got exciting prospects ahead. We launched Raymond Khadi in 17-18, and we are very bullish on Raymond Khadi also scaling up. It's got exciting prospects both domestic as well as in the export market. So that's about it.
Okay, Sanjay, also we would like to know on the distribution front as to how really the company is looking to add stores, especially in the franchise model. If you could give us a path as to how will you ramp up your distribution in the next 12 to 18 months.
We have an aggressive rollout plan of increasing our retail footprint, and that is really underpinning our strategy for driving growth in both the fabric business as well as the apparel business. So in 17-18, we added a net 139 stores. But the good part is that out of the total retail footprint addition that we are doing, a bulk of it is a very unique innovation of a mini Raymond store, which is a one-stop shop covering both fabric and apparel that we are targeting at the tier 4 to tier 6 towns. So last year, 91 stores were opened, and in 18-19, we are targeting to open another 200 stores. So overall, we see addition of about 250 stores in 18-19. So grow the retail footprint very aggressively is a key strategy for us. Also, 75% of these stores are going to be through the franchise route. So it's going to be asset light as far as the company is concerned. And this will also help to really keep the working capital levels low and also give us better margins.
Okay. Sanjay, last quarter also we spoke with you regarding the Thane land and how really, would the investment plan shape up. Of course, you did not give details then, but if you could now tell us, since the board has approved a 300 crore investment outlay, how would this, investment shape up, and what is the status of approvals as far as this 20-acre land parcel that you are planning to develop into a residential project?
So right now, what I'm happy to report is that the board has approved development of 20 acres of land for residential purposes. We have secured a major part of the regulatory approvals that are required, and a few are in process. The teams have been engaged, as I have mentioned earlier, over the last few quarters into evaluating various options, and finally we are at the stage of execution now. The final plans are being made based on the guidance that we have got from the board, and the project plans will be announced shortly. The 300 crores is really the estimate that we feel that we'll be spending in the current fiscal year towards the project development and construction, which we feel will get started during the year.
Okay, so that was the management of Raymond, and thank you, Mr. Bahl, for speaking to BloombergQuint.